Welcome back. You're watching the CNBC TV 18 special from the India Economic Summit. We're in conversation with GE's Vice Chairman, John Bryce. Let me ask you a little bit about how you see global growth and the challenges that we're seeing as far as global growth are concerned. You know, the IMF has pretty much retained the global growth outlook, at least for now, but there are risks on the downside. What is the sense that you get? You continue to say that China is not a terrible story. It's not a macro story, it's a micro story, and there are specific sectors, for instance, that are booming in China, or continue to boom in China, like aviation, but maybe construction and mining not doing particularly well. So, you know, what is the sort of headwinds that you see as far as global growth are concerned?
Well, global GDP rate at 3+ something %, depending on who's measuring it, half of what it was 5 years ago. A lot of that driven by the commodity cycle. You know, the commodities are also, in many cases, half of what they were, giving governments less money to spend. Still a huge demand for infrastructure. So there's, by some estimates, $1 trillion shortfall in the infrastructure investment around the world. There's 1.5 billion people that lack the basics. We've talked about this before. Sure. And so, so the connection now is between the need for infrastructure and financing capital. So we and other companies have to be good at connecting capital from the people who want to invest in long-lived assets to the projects that allow, that facilitate the build-out of this infrastructure.
Since you were talking about commodities, let me ask you about oil in specific. And I remember Jeff telling David Fravor, our colleague in the U.S., that, you know, doing business when oil is at 50 is not that much fun. And we're pretty much at that level at this point in time. You've tried your best to take out costs, and you continue to try and take out costs as far as the oil and gas business is concerned. But what is the outlook now as far as crude is concerned, and what that means for the oil and gas business in specific?
Well, I'm the wrong guy to predict the price of crude, because like everybody else, I'm more likely to get it wrong than right. But the thing about $50 a barrel oil is it does force you to clean out the closet and get cost in the right places. The other thing is it puts a real premium on your ability to deliver solutions that can be directly linked to a lower cost of exploring, extracting, processing a barrel of oil, a ton of iron ore. And so for us, it's sharpened our pencil, and it's sharpened our focus on delivering solutions that really matter to our mining or oil and gas customers. And I don't think that's a bad thing. Painful, and you go through a process to get to the right cost level. But in the long run, I think we're going to end up being a better company because of what's happened.
Is there room to take out more costs, though?
There's always room to take out costs. And you have to think of it that way. Nothing's fixed. But you know, it's not an absolute cost level, it's a relative cost level, and it's making sure you have the right cost in the right places. You know, you don't take 5% out everywhere. You take 20% out of some places and add in other places.
So, you know, let me talk to you about the bets that you're making on the future. And this is, of course, a part of your strategy to position yourself as a digital industrial company in the future. You've invested or done some acquisitions in what you call as the additive manufacturing space, 3D printing and so on and so forth. Are we likely to see you do much more on that front?
Yeah, we want to build out this space, you know, whether that's organically or inorganically. We love the deals that we've announced, and we're working hard to close them. Material science is at the core of what it will take for us to be successful in the 21st century. Our jet engines, our gas turbines, our technology products push the limits of physics in terms of the way they run and temperatures and speeds. So being able to use the most advanced materials to manufacture parts and components in the most efficient way possible, we think is one of the keys to our success, and that's where additive plays in. So we like this to support our businesses, and we also like it because we think there's going to be big demand for these products in industry, and we can be one of the suppliers.
So, you know, from where you sit today, do you believe that inorganic growth is probably going to be the preferred route, or perhaps the easier route to try and acquire these capabilities that you're hoping to acquire?
No, I don't. I think inorganic will be the place we go to fill out some of the capabilities that we think we need to have, but You know, we're very thoughtful about it. We're going to do it selectively. We spend $5 billion a year on research and development and new products, and that has to translate to organic growth. So we're always going to be a company where organic growth is important.
Appetite for big-ticket deals, Alstom-like deals, or you believe you're done for now?
I don't see anything like Alstom on the horizon. We love what we got with that deal. We're in the process of assimilating it. It's going extremely well. If anything, we've seen a few more synergies in some places that we didn't fully expect. I don't think we're going to see anything of that size in the near term.
Yes, $13.5 billion, not easy to digest. On that note, it's time for us to take a break, but when we return, we continue our conversation with the Vice Chairman of GE, John Rice.